after public sector insurance behemoth Life Insurance Corporation of India trimmed the size of its initial public offering from over 60,000 crore rupees to 21,000 crore rupees. SoftBank-backed Delhivery has trimmed its issue size from 7,460 crore rupees to 5,500 crore rupees in order to align with the volatile market conditions. Delhivery's IPO will be the second biggest this year, next only to LIC's, and among the top 5 since 2021. Besides these two IPOs, nearly half a dozen companies plan to raise a total of over 7,500 crore rupees via primary markets in May alone. According to a recent note by Prime Database, 54 companies including LIC plan to raise a massive 1.4 trillion rupees in 2022. These companies hold market regulator Securities and Exchange Board of India's approval. Another 43 companies, the note said, were looking to raise about 81,000 crore rupees where SEBI approval was still awaited. The largest IPO in 2021-22 in terms of size and also the largest Indian IPO ever until the LIC IPO was that of 197 Communications at 18,300 crore rupees. This was followed by Zomato, Star Health, PB Fintech, Sona BLW and FSN e-commerce. So what's in store for primary markets in the months ahead? Will the fundraising frenzy slow a bit? According to Sunil Tirumalai, strategist at UBS Securities India, primary markets will definitely see a fallout of slowing flows and pressure on valuations. The downsizing of the LIC IPO is an example of that. Now, let's go to Ambarish Baliga, an independent market analyst, to understand the dynamics in detail.
Normally, the IPO takes about 12 months of planning and execution. The market environment is dynamic, and at times it becomes necessary to take action to fall in line with the market condition. At times, IPOs are shelved too when the environment is not too conducive. Therefore, trimming the IPO size as well as the valuation is a prudent thing to do, looking at the choppiness in the market, just to ensure that the IPO is a success. Just like investments, it's difficult for an issuer to time the IPO, especially in times like these. This is when the pricing or valuations become important. If there is enough left on the table for investors, one can still garner subscription. For the issuer, when it's a choice between lower valuation against a failed IPO, I think the former is always preferable.
So, will volatile market conditions see companies trimming their offer size? Here's what VK Vijay Kumar, Chief Investment Strategist at Geojit Financial Services, says.
In a bull market, even mediocre IPOs, overpriced IPOs, get fully subscribed and oversubscribed. Later, when sanity returns, market punishes these IPOs and the market price goes below the issue price. The most important takeaway from the recent frenzy in the IPO market is to get the issue price right. Otherwise, disasters like Paytm's will happen. If LIC had persisted with their original plan to offload 5% of the equity, LIC would have found the going very, very tough. But by revising the IPO down to 3.5% of equity, that too at an attractive valuation of 1.1 times the embedded value, the issue is getting a very good response, even in these difficult times. Issuers need not wait for a favorable time and postpone the issue, because a favorable time will never come. This year, market is likely to remain challenging. So the message from the market is very clear. Get the pricing right and leave some money on the table for investors.
Today, the markets will react to the US retail inflation numbers and how the global markets perform. Stock-specific action is likely to continue amid volatility.
If you like this video, share it and subscribe to Business Standard. For more news, views and insights, log on to www.business-standard.com. Do also follow us on YouTube, Twitter, Facebook, Instagram, Telegram and LinkedIn.